Every system reveals its true nature, not in how it begins, but in how it never ends. So before we talk about numbers, before we talk about trillions, pause for a moment and notice something unsettlingly simple. Every country on earth is in debt. Not some, not most, every single one. The United States owes tens of trillions of dollars. Japan owes trillions. European nations owe trillions. Developing nations owe trillions. The total global debt now exceeds the size of the entire world economy several times over. And that alone should stop you. Because debt, by definition, implies a relationship. Someone owes. Someone is owed. So ask yourself, slowly, carefully, if everyone owes money, who exactly is on the other side? This is where most explanations become evasive. They tell you debt is normal. They tell you debt fuels growth. They tell you debt will be managed over time. But they rarely answer the core question. Who designed a system where debt never disappears? Because historically, that is not how debt worked. For most of human history, debt was temporary. Kings borrowed to fight wars or build infrastructure. They repaid when they could, and when they couldn't, they defaulted. Defaults were painful, embarrassing, destabilizing, but they cleared the system. Creditors lost money, debtors lost credibility, and the slate eventually reset. Debt had an end point. That changed at a specific moment in history, and once it changed, it never went back. This story does not begin in modern America. It begins in late 17th century Europe, during a period of constant war, fragile monarchies, and empty treasuries. England, in the 1690s, was nearly bankrupt. Years of war against France had drained tax revenue. The crown had defaulted before. Private lenders were increasingly unwilling to lend directly to the government. The problem was structural. Governments needed enormous sums of money quickly, especially during war, but traditional lending made default a real risk for creditors. Enter a merchant and financial thinker named William Paterson. Paterson was not a king, not a noble, not a general. He was something far more consequential, a system builder. Paterson proposed something radically new. Instead of borrowing money with the intention of repaying it, the government would borrow money with the intention of never repaying the principal at all. The idea was simple, elegant, and revolutionary. A group of wealthy investors would lend the government a large sum. The government would pay interest every year, indefinitely. The principal would never be retired. To manage this arrangement, a new institution would be created, a central bank. In 1694, Parliament approved the plan. The Bank of England was born. This was not a conspiracy. It was a documented, legislated innovation, and it changed the nature of debt forever. For the first time, national debt became permanent, not a burden to eliminate, a structure to maintain. The genius of the system was not in the interest rate, it was in the guarantee. Interest payments were backed by the government's power to tax. As long as the state existed, as long as it could collect revenue from its citizens, the payments would continue. To investors, this was extraordinary. They were no longer lending to a king who might default. They were buying a perpetual income stream backed by an entire population. Even more transformative was what came next. The bank issued notes backed by the government's debt, and in other words, the government's IOUs became money. Debt didn't just finance the state, it became the foundation of the monetary system itself. From that moment forward, money and debt were inseparable. And once money is created through debt, repaying that debt becomes dangerous, because repayment destroys the money supply. This is the paradox at the heart of modern finance. Governments cannot eliminate debt without collapsing the system built upon it. Within decades, other nations copied the model. France, the Netherlands, later emerging republics. By the late 18th century, the idea that government debt should be permanent was no longer controversial. It was orthodoxy. When the United States gained independence, it inherited this thinking. Alexander Hamilton, the first Treasury Secretary, explicitly modeled America's financial system on European precedents. Permanent debt, interest funded by taxation, bonds traded on open markets. Hamilton argued that a national debt, if not excessive, would be a national blessing. What he meant was not moral virtue. He meant financial structure. Debt created alignment between wealthy creditors and the survival of the state. If influential investors owned government bonds, they would support the government that paid them. Stability through obligation. And for decades, the system functioned with limits. Governments could borrow, but only as much as lenders were willing to provide. That constraint mattered. The next transformation removed it. In the 19th century, sovereign debt became industrialized, not through ideology, but through logistics. Families like the Rothschilds did not invent debt. They perfected its distribution. By establishing banking houses across multiple financial centers, they created something unprecedented, a transnational market for government bonds. Debt could now be bought, sold, collateralized, and transferred across borders at speed. This mattered for one critical reason. Default was no longer bilateral. It was systemic. If a government defaulted, it wasn't refusing one creditor. It was destabilizing an entire financial network. Debt became too interconnected to fail. This is not speculation. It is the foundation of modern bond markets. By the time the United States entered the 20th century, the remaining constraint was monetary. Money creation was still tied, imperfectly, to gold and private bank reserves. That constraint disappeared in 1913. The creation of the Federal Reserve System introduced a lender of last resort with the power to create money and purchase government debt. This did not immediately create runaway borrowing, but it removed the ceiling. From that moment on, there would always be a buyer for government bonds. Always liquidity, always rollover, always refinancing. Debt could grow without immediate consequence. The final evolution came in the late 20th century. When debt became too large to service, it was no longer forgiven. It was restructured. International institutions provided new loans so old interest could be paid. Austerity replaced default. Restructuring replaced resolution. Debt became eternal. At every stage, the system solved a real problem. Funding war, stabilizing markets, preventing collapse, and at every stage, it shifted cost forward in time. Onto future taxpayers. Onto abstract balance sheets. Onto generations not yet born. This is where we are now. A global system where debt is not a failure, but a feature. Where repayment is impossible without collapse. Where interest flows upward, continuously, quietly. And where the question is no longer, how did we get here? But, what does it mean to live inside a system that cannot end? In the next part, we will examine how this structure functions in modern America. Who holds the debt? Who benefits from it? And why $38 trillion is not a mistake, but a signal. To understand why American debt behaves the way it does today, you must abandon the idea that it functions like household debt. This is the first psychological trap. Household debt has an endpoint. A mortgage is paid off. A loan is retired. A balance reaches zero. Sovereign debt does not work this way, not because it cannot be paid, but because paying it would destabilize the very system that depends on its existence. The United States does not treat its national debt as a liability to eliminate. It treats it as infrastructure. This distinction is subtle but decisive. American government debt is issued primarily in the form of treasury securities, bills, notes, bonds. Each represents a promise, principal plus interest, paid over time. These instruments are considered among the safest assets on earth. Why? Because they are not backed by gold, not backed by resources, not backed by balanced budgets. They are backed by the productive capacity of the American economy and the government's ability to tax it. That ability is vast, and as long as it exists, treasuries remain attractive. This attractiveness creates constant demand. Demand is the engine of permanence. The second psychological trap is the belief that China owns America. This phrase is repeated so often it feels intuitive. It is also incomplete. Foreign governments and institutions do hold U.S. debt. China, Japan, oil-exporting nations, global financial institutions. But the majority of U.S. debt is owned domestically, by pension funds, by insurance companies, by mutual funds, by the Federal Reserve itself. This matters, because it means American debt is not primarily a tool of foreign control. It is a mechanism of internal financial circulation. When the government issues debt, it creates a safe asset. That asset becomes collateral. It stabilizes portfolios. It underpins retirement systems. It anchors the financial architecture. Remove it, and the structure collapses inward. This is why paying off the debt is never seriously proposed. Not because politicians are irresponsible, but because the debt performs too many functions to disappear. It absorbs surplus capital. It sets the risk-free rate. It allows banks to meet regulatory requirements. It enables monetary policy. In other words, debt is the foundation. This creates a paradox. The more debt exists, the more the system depends on it. And the more the system depends on it, the harder it becomes to reduce. The third transformation occurred when the Federal Reserve began purchasing massive quantities of government debt. This process is known as open market operations. In plain language, the central bank creates money and uses it to buy government bonds. This is not hidden. It is not illegal. It is not controversial among economists. It is policy. During crises, this process accelerates. The financial crisis of 2008 marked a turning point. To stabilize collapsing markets, the Federal Reserve expanded its balance sheet dramatically. Trillions of dollars were created digitally and used to purchase treasuries and other assets. This did not immediately cause inflation. Why? Because the money remained largely within financial markets. It inflated asset prices, not consumer prices. Stocks rose. Real estate rose. Inequality widened. The system absorbed the expansion. Then came the pandemic. This time, money flowed directly into households and businesses. Stimulus checks, emergency loans, relief programs, debt exploded. But something else happened. For the first time in generations, inflation returned. This revealed a critical truth. Debt itself is not inflationary. Where the money goes matters. Yet even inflation did not stop borrowing, because stopping would have meant collapse. Here is the core reality. The U.S. government does not borrow in the way individuals borrow. It issues currency-denominated obligations in a currency it controls. This grants extraordinary flexibility. As long as obligations are denominated in dollars, default is unnecessary. Payment can always be made. The constraint is not solvency. It is confidence. Confidence that the currency will retain value. Confidence that institutions will function. Confidence that obligations will be honored in real terms. This is why discussions about debt ceilings are political theater. The real limit is psychological. Once confidence erodes, everything accelerates. This is why the system is designed to maintain trust above all else. Through messaging, through continuity, through ritual. Markets open every day. Interest is paid on time. Treasuries roll over seamlessly. Normality is maintained, because normality is the system. This brings us to the most misunderstood point. The debt is not an error. It is a signal. It signals that the system is operating as designed. Continuous issuance, continuous rollover, continuous growth. The problem is not the number. The problem is the trajectory. As debt grows faster than productive output, pressure accumulates. Interest consumes more revenue. Political trade-offs intensify. Future promises crowd out present flexibility. This does not cause immediate collapse. It causes brittleness, a system that functions until it doesn't. History shows how this ends. not through repayment, not through reform, but through restructuring. Inflation, currency devaluation, financial repression. Debt is never eliminated honestly. It is diluted. Those holding cash lose purchasing power. Those holding assets are protected. Those without either pay the price. This is not ideology. It is precedent. Rome did it by debasing coinage. Modern states do it digitally. The mechanism is different. The outcome is the same. In the next part, we will examine how this system shapes behavior, political decisions, media narratives, and personal psychology, and why intelligent people can sense something is wrong without being able to articulate it. When people say the system feels impossible to escape, they are not speaking metaphorically. They are describing a psychological condition created by structure. Because the most effective systems of control do not rely on force, they rely on inevitability. The modern debt-based economy does not threaten people into compliance. It convinces them there is no alternative. This begins with language. From childhood, Americans are taught to think of money as neutral, debt as normal, and growth as mandatory. Economic cycles are described as weather. Booms happen. Busts happen. No one is responsible. This framing is subtle, but powerful. If economic outcomes are natural phenomena, then questioning structure feels pointless. You do not argue with gravity. You adapt to it. This is the first layer of psychological containment. The second layer is personalization of failure. When systems are structured to generate inequality, the burden of explanation is shifted onto individuals. If you struggle, you are told to work harder. If you fall behind, you are told to retrain. If you cannot keep up, you are told the economy is competitive. Structural pressure becomes personal inadequacy. This isolates people. Isolated individuals do not coordinate systemic critique. They internalize blame. The third layer is distraction through complexity. Modern finance is intentionally opaque, not because it must be, but because opacity protects legitimacy. Derivative markets, monetary policy, bond yields, balance sheets. The sheer volume of terminology discourages engagement. People sense manipulation, but lack vocabulary. Without language, intuition remains vague, and vague discomfort is easily dismissed. This creates a peculiar tension. People feel trapped, but cannot articulate by what. They sense unfairness, but cannot locate its source. They suspect design, but are told it is chaos. This dissonance produces exhaustion. Exhausted populations do not resist. They adapt. Media plays a critical role here. Most economic coverage focuses on symptoms, not structure. Markets rise, markets fall, inflation surprises. Jobs reports disappoint. These are treated as events, rarely as consequences, rarely as outcomes of long-term design. This episodic framing prevents pattern recognition. Without pattern recognition, outrage resets every cycle. Nothing accumulates. The next mechanism is fear management. The system does not need people to believe it is just. It needs them to believe that alternatives are worse. Any serious challenge to the status quo is framed as dangerous, irresponsible, radical, naive. Historical examples of reform are either romanticized or demonized. Rarely analyzed soberly, this narrows the imagination. People can imagine collapse. They can imagine stagnation. They struggle to imagine transformation. This is by design. The philosopher Michel Foucault argued that power is most effective when it limits what can be imagined, not what can be said. Modern economic discourse allows endless debate, but within tight boundaries. Tax rates may change. Spending priorities may shift. Parties may alternate. The underlying architecture remains untouched. Debt-based money, interest compounding, asset inflation, labor commodification. These are treated as immutable. When something is framed as immutable, resistance appears futile. Futility breeds resignation. Resignation stabilizes systems. Another critical factor is temporal mismatch. Human psychology evolved for immediate feedback, but debt systems operate on decades. Decisions made today produce consequences far in the future. This disconnect breaks accountability. Politicians benefit now. Markets respond now. Voters feel impact later. By the time consequences arrive, decision-makers are gone. Memory fades. Blame diffuses. This creates moral hazard at scale. And finally, there is the issue of dependence. Most Americans rely on the system they suspect is rigged. Jobs, healthcare, retirement savings, credit access. Opting out is not realistic. This creates a quiet, psychological contract. As long as the system functions, questioning it feels risky. Better to survive within it than challenge it without guarantee. This is not cowardice. It is rational adaptation. But rational adaptation at scale produces collective paralysis. The system does not require belief. It requires participation, and participation is secured through necessity. This is why awareness alone does not produce change. Understanding the trap does not automatically open the door. In some cases, it deepens the sense of enclosure. This is the final containment layer. Knowledge without agency breeds cynicism. Cynicism breeds disengagement. Disengagement preserves structure. So the question becomes sharper. If the system cannot be escaped, what does agency look like? If reform is slow and uncertain, what does responsibility mean? And if collapse is not imminent, how should intelligent individuals orient themselves inside a structure designed to outlast them? In the final part, we will confront these questions directly, not with slogans, not with false hope, but with a sober examination of what meaningful action looks like when the system is real, resilient, and deeply entrenched. There is a moment that comes after understanding, when clarity becomes uncomfortable. Because clarity removes illusion, and illusion, however false, often provides emotional shelter. Once you recognize that the system was not accidentally built, but deliberately structured, the question shifts. It is no longer, how did this happen? It becomes, what does it mean to live inside it? This is where most discussions collapse into extremes. One side retreats into denial, the other into rage. Both are forms of avoidance. The truth is more demanding. No individual alive today designed this system. No single administration created it. No generation consciously voted for its final form. Yet participation is unavoidable. You earn within it. You save within it. You retire within it. You measure success through its metrics. This creates a paradox of responsibility. You are not guilty, but you are involved. The Stoic philosophers understood this tension deeply. They distinguished between control and responsibility. You are not responsible for outcomes beyond your control, but you are responsible for how you orient yourself toward reality once you see it clearly. Orientation is where agency begins, not in rebellion, not in withdrawal, but in refusal to be psychologically managed. The system does not fear anger. Anger is predictable. Anger is exploitable. Anger burns out. What the system cannot easily absorb is composure. Composure slows reaction. It resists urgency. It demands coherence. A composed citizen does not panic at headlines, does not confuse volatility with meaning, does not outsource judgment to authority or tribe. This alone alters behavior. Markets are driven by expectation, politics by perception, systems by momentum. Momentum depends on speed. Speed depends on unexamined response. When enough people slow down, even slightly, pressure changes. This is why true agency today looks subtle. It looks like asking better questions, not louder ones. Who benefits from this policy? Who bears its cost? Is this decision reversible? What incentive does it create 10 years from now? These questions are not radical. They are stabilizing. They introduce time into a system addicted to immediacy. They reintroduce consequence into decisions insulated from it. This form of agency does not promise dramatic victory. It promises resilience. Resilience is underrated. Systems do not collapse because people understand them. They collapse when too many people lose faith. Faith is fragile. Legitimacy is fragile. And legitimacy depends not on perfection, but on credibility. When institutions consistently explain symptoms instead of causes, credibility erodes. When promises repeatedly defer cost, credibility erodes. When complexity is used to avoid accountability, credibility erodes. Erosion is slow, then sudden. History offers no examples of debt-based systems ending cleanly. They end through transformation, sometimes controlled, sometimes chaotic. The outcome depends largely on public literacy. Populations that understand structure adapt earlier. They diversify risk. They resist manipulation. They demand coherence. Those that remain distracted experience shock. This is not prophecy. It is pattern. So what does responsibility look like, realistically? It looks like refusing to confuse comfort with stability. It looks like understanding that growth financed entirely by debt is not growth, but acceleration. It looks like recognizing that inflation is not a failure of policy, but a method of adjustment. It looks like preparing psychologically for change rather than clinging emotionally to permanence. This does not require abandoning the system. It requires not worshipping it. There is a difference. You can operate within a structure without internalizing its myths. You can use money without believing it defines value. You can participate without surrendering discernment. This posture changes how people invest, vote, speak, and listen. Not dramatically, but cumulatively. And cumulative change is the only kind systems this large respond to. If you have remained with this analysis to its conclusion, it suggests something important. You are not looking for reassurance. You are looking for orientation. Orientation in a system that feels inescapable. Orientation in narratives that feel incomplete. Orientation in an economy that demands belief. That orientation matters. Because the most powerful systems in history did not fail because they were evil. They failed because people eventually saw them clearly. And clarity, once widespread enough, changes behavior. Not overnight, but inevitably. If this work helped sharpen your understanding rather than inflame your emotions, then it has done what it was meant to do. If you believe conversations like this deserve continuation, not as outrage, but as serious inquiry, staying connected ensures that depth is not replaced by noise. A simple signal of support helps this reach others who are also looking for clarity, not slogans. And if you choose to share it, do so deliberately, not publicly for attention, but privately with someone you respect, someone who enjoys thinking slowly about difficult systems. Finally, if you leave a comment, make it meaningful. Not agreement, not praise, contribution. Because thoughtful dialogue is one of the few forces capable of resisting systems designed to move faster than understanding. This system was not built for you to escape. It was built for you to participate without questioning. The moment you question, calmly, precisely, and persistently, participation changes. And that is where real freedom still exists.